Thank you for your interest in our study, The Effects of Mutual Fund Decarbonization on Stock Prices and Carbon Emissions. In this short video, we present the key contents and results of our work. If you have any questions about our study beyond the paper, please feel free to contact us. The most important result in advance. Divestment can lead to more sustainability in the real economy, which means it can have a real impact. We were able to show this empirically for the first time with our study. The fight against climate change is one of the most urgent problems facing the global community. In order to achieve the transition to a carbon-neutral economy, financial flows must be diverted from climate-damaging to climate-friendly companies. A popular instrument for this is the so-called divestment, which means the sale of climate-damaging shares. This is also referred to as decarbonization of portfolios. But does this have any effect at all? So far, only theoretical considerations exist on the effectiveness of divestment, such as the equilibrium model by Heinkel, Krauss and Zechner from 2001, which suggests a potential connection between divestment, falling share prices, and lower carbon emissions. Our study now provides the first empirical evidence on the actual effectiveness of divestment. Why do we look at equity funds for this purpose? These are particularly well suited for studying divestment because they manage a large amount of capital. Moreover, they are currently under strong pressure to decarbonize from their investors, who no longer find climate-damaging stocks attractive. Thus, funds could put a lot of selling pressure on the stocks. In addition, we use the financial and carbon data of the companies held by the funds. So how can we use this data to identify divestment and analyze its impact? In the first step of our new methodology, we identify in each quarter those funds that have decarbonized particularly strongly. Then we look at the sales of these funds to identify sales with a decarbonization background. In the second step, we use this to calculate the divestment selling pressure for each stock and identify stocks that have been strongly divested from the overall fund market. As control groups, we use stocks with a high general selling pressure, for example for financial reasons, and stocks without any selling pressure. First, we compare the stock price developments of these three groups using an event study. The horizontal axis shows the months before and after the divestment event. The vertical axis plots cumulative industry-adjusted returns, which represent relative stock price changes. As the solid black line shows, divested stocks have no relevant price changes before the divestment, a sharp price decline in the divestment quarter, and ongoing negative returns afterwards. The overall price decline from the divestment is about 6.5%. This behavior is clearly different from that of the two control groups, suggesting that financial reasons cannot explain the price decline. In summary, this means that collective divestment by equity funds can exert sufficient selling pressure to cause the stock prices of climate-damaging stocks to fall in the long run. But does this also lead to a change in the behavior of the companies concerned? To answer this question, we compare the developments in carbon emissions of the three groups using another event study. The horizontal axis again shows the months before and after the divestment. This time, the vertical axis shows cumulative changes in carbon emissions. The control group's emissions increase steadily by about 10% over the study period. In comparison, the emissions of the divested stocks increase more before the divestment, but much less afterwards. After some time, carbon emissions even fall below the level at the divestment event. In summary, this means that the lower share prices represent a real incentive to make the companies concerned more climate-friendly from within, in order to make them more attractive to investors again. As an interim result, we are thus able to document for the first time the relationship between divestment, stock prices, and carbon emissions, which was previously only shown theoretically. To further test for causality of the relationship, we conduct numerous tests against selection bias and endogeneity, including various regression methods, additional control groups, and alternative explanations. In summary, we find that there is causality between divestment and the reduction of carbon emissions. Investors can therefore have a real impact against climate change by divesting. Thank you for your attention.